So, the next guy doesn't use slides, does not have handouts, does not teach classes, does not sell anything other than increased rents on his apartment units and his single-family rentals. If you've ever met anyone happy about not paying the IRS $1, Scott Belsey actually ups that person by 50% guaranteed. He is a man that's passionate about paying your fair share, but redefining what fair means. And one of the benefits of being a landlord, a real estate owner, etc., is being able to rewrite those rules. So this is the last session of the night. Scott's going to have at least 40 minutes. Listen to this man because he's what I want to be when I grow up. So, Scott Belsey. It's not that late at night. There's no steps. So you'll be all right. Thank you.
Well, how's everybody today? Well, I'm going to talk about kind of a boring subject, but I'll tell you a little bit about my background first. I came to Dallas in 1967, went to college, graduated in 71, went to work for a big CPA firm downtown. Then I got lucky and I got a job at Lincoln Properties as a divisional comptroller. And that's where I saw real estate from a different viewpoint. And I decided, well, if they can invest in real estate, make all this money, I can do it. So I took the little savings I had and I bought a 6-unit building on Cole. Everybody know where Cole is in Dallas? Well, Main Street. Currently, where my first building is where the Starbucks in West Village is. I wish I still owned it. You know, I don't own it anymore. But in a year, I made 10 grand, and I said, hey, this is business to be in. So, and then over the years, I've built that up to where I now have, I manage somewhere in the neighborhood of 2,650 units. I own about 75 to 80% of them. I have houses and apartments both, one mobile home park, and I can tell you the level of the tenants like that. And I also do some financing. I don't compete with the hard money guys. I do owner finance properties.
The Belsey presentation has begun.
Oh, thank you. So, but I'm here to talk about not my real estate business as much as the tax business. And I did have an accounting practice, tax and bookkeeping practice for 30 years. Had a lot of real estate clients. And now I'm going to talk to you guys about some things about real estate and taxes, how they work with each other. Number one, rental properties, like any kind of business, the income is taxable, like the rent, the expenses are deductible. But if you collect a deposit, that's a liability. That is not taxable. Make sure you don't put that as income. If you pay it back at a later date, you can't deduct it, but that's kind of like a loan from the tenant. Also, other things that are income other than the rent, late charges, eviction fees. And every once in a while, you get something like, I had one house in Grand Prairie where I got some money from one of the oil companies. So that's income. Expenses, you've got things like repairs, insurance, property taxes, interest, and there's a lot of little other things that you can deduct. Advertising, commissions, if you pay a commission to somebody to lease it, salaries if you have employees, contractors, and you can even, in professional fees, and even if you have enough property, you can deduct an office and a home. And we'll talk about that later. Another thing that saves us a lot in real estate is we can depreciate our property. We are in a unique business. We can actually write off a property that goes up in value. It's great. It goes down in value for the government, but it goes up in value as far as we're concerned over time. And depreciation is an entry that you have. The theory is your house or apartment building is worth zero at the end of X number of years. But if you take care of it, it's just fine. Basically, you have straight line depreciation, you've got accelerated depreciation. Any accelerated depreciation over and above straight line is subject to what they call alternate minimum tax, and we'll go into that later. That's kind of complicated. You also have some depreciation items that you can write off up front. It's called Section 179. It's a part of the IRS code that allows you to expense equipment up front. There are some rules against for it, but if it's a small amount of money, no problem. You also have a 50% bonus depreciation up front that you can take, and all of these are on equipment type items. Doesn't work on the real estate portion, but if you have a vehicle, you have tools, you can deduct those in that manner. Another beauty about real estate is component depreciation. Basically, when you buy a piece of property, you have land and you have a building. Well, the land is not depreciable because the land, in theory, exists forever. But the building, at some period of time, will be worth zero, in theory. And in residential real estate, you can depreciate your building over 27 and a half years, commercial real estate, 39. Apartment buildings are considered residential. So they fall under the same attributes that houses fall under. One thing that we can do is we can pull out some of the components of the property. When you buy a property, you have appliances, you have carpet that is not going to last 27 and a half years. So you can take part of that cost and put it in a separate category and depreciate that over a shorter period of time. Generally speaking, there is basically three major different types of components. You've got the building, you've got the land, you have what they call site improvements, which is a 15-year life, and you have the personal property, which has got a 5-year life, 5 to 7-year life. So if you buy a piece of property and you pull out the site improvements and you pull out the personal property, you're going to be able to take part of your cost and depreciate it over a much shorter period of time. Generally, what I do is use 10% for land, 10% for site, 10% for personal property, and 70% for the building. This allows me to obtain somewhere around a 7 to 8% of your cost is depreciation. And that gives you a nice upfront tax deduction. Commercial property, like a warehouse, has a 39-year life, and that's not near as lucrative on the depreciation side. Included in what we would call personal property would be things like carpet, appliances, window attachments, an air conditioner, a window air conditioner, and a regular air conditioner, but not the ductwork, because the ductwork is considered perfect, but the condensing unit is basically bolted down. And an air conditioner doesn't go last 27 and a half years. The 15-year life has things like landscaping, and don't ask me why. Sometimes the IRS rules don't make sense. Plumbing, electrical, fence, and driveways. And you're allowed to write those off over 15 years. Then another thing you've got to look at is when you sell your real estate is a capital gain. And a capital gain has a special tax rate. Generally speaking, it is a 20% tax rate versus if you're in a 35 or 40% tax bracket. So you can actually sell a piece of property and pay a lower tax on the gain. It's interesting that they've changed the capital gains back and forth over a number of years, but the first bracket is actually at 10%, then it goes to 20, but most of us will be in the 20. So if we sell a piece of property, we pay $100,000 for a piece of property, and we sell it for $150,000, that's a capital gain of $50,000. And assuming our basis is $100,000, that we'd have a $50,000 gain times 20% or a $10,000 tax. Now, what complicates things is when you take depreciation, it reduces your tax value of your property. And when you sell it, it has to be recaptured. So I take that $100,000 piece of property and I have taken $20,000 in depreciation. My current basis is $80,000. So $80,000 subtracted from $150 is a $70,000 gain. So you have to watch the fact that when you sell your property, you have to recapture the depreciation. And if you have a capital gain and it is less than 1 year or less, it is at ordinary rates. You have no break on taxes. But if it's a year or more, it's a 20% tax. Another thing, and I'm going to talk a little bit about different types of entities now. Basically, you've got a C corporation, and a C corporation is a corporation with a perpetual life. It is taxed at the corporate level. Exxon, AT&T, all these big companies are C corporations, and they pay tax at the corporate level. Their tax rate starts at 25%, goes to 34%, and levels out at 34%. You also, also on a C corporation, you have to file a franchise return with the state, and that is also an additional tax dependent upon how big it is. And I'll talk about franchise taxes in a minute. Then you have another type of a corporation called an S corporation. That means that the corporation does not pay tax at the corporate level. The income flows to the owner. So if you own 25% of an S corporation and the S corporation makes $10,000, $2,500 of that will flow to your personal return. And you'll pay tax on that at the personal rates. S corporations do have some rules. You cannot have more than a certain number of investors. You can't have more than one class of stock. And then, because a lot of people complain about S corps, the state came up with a new entity called an LLC. The LLC's only been around about 12 years, which is the popular way of buying property today. The problem with an LLC is IRS has a different definition of an LLC than the state, which I'll explain to you in a minute. But an LLC, IRS does not recognize an LLC, but you could take an LLC and take an election to be a C Corp, an S Corp, or partnership, or a proprietor. And I'll get to partnership and proprietor in a minute. But the nice thing about the LLC is you have more flexibility. You can have many shareholders, different classes of stock. You can do a lot more things than you can than an S Corp. And that is a popular thing that most people do today. Be aware on an LLC that you have to file an election to be taxed as one of these other items. Or if you're a one-owner LLC, you're automatically a proprietorship. A two-owner LLC, you're automatically a partnership. Now I'm going to talk a little bit about partnerships. That's another type of an entity, and there's two different types of partnerships. There's a general partner where there's just two people or three or five all put their money together and they're all liable for whatever the other person does. A limited partnership has protection for the limited partners, but there has to be a general partner that has no protection. And for many years, limited partnerships were a popular thing to do the syndications. And there are some, in tax-wise, whether you're a general partnership or a limited partnership, the income or losses flow to the investors or the owners pro rata. It works just like a sub-S corporation on the tax side, except it is a different type, it's a different form and a different tax entity. The other type of entity you have is a proprietor. That means you're just setting up a business, you own it, you're not setting a corporation up or anything. Proprietorship requires virtually nothing to start with. If you want to open a bank account, all you need is a DBA and bingo, you're ready to go. You don't have to do any corporate papers or anything fancy like this. But it is, you have complete liability, which the lawyers, generally speaking, want you to do some type of an entity if you're looking at a liability protection. Now, all of these entities that have protection, a C Corp, an S Corp, a limited partnership, and an LLC, are required to file a franchise return with the state of Texas. And if you don't file that once a year, you'll lose your right to be a corporation and lose the protection. What's interesting is if your revenue or sales is $1 million a year or less, there's no tax. So all you got to do is file 2 or 3 pieces of paper and you're fine. But if you don't file it, you could lose your right to be a corporation. So be sure if you are an LLC, a limited partnership, a C or an S Corp, that your franchise returns are filed every year. Fortunately, our state has a lot less paperwork than some of the other states. California's got 30 pages. Texas has got 2 to 3, depending upon what type of entity you are. Generally speaking, I'm going to talk a little bit about accounting methods. I don't know how many of you are familiar with cash or accrual accounting, but cash accounting, and you have the option of picking your accounting method on any of these type of entities, but once you pick it, you must stick to it. A cash accounting means if you receive the money, it's taxable income. You write a check, it's a deduction. Accrual means if you've earned the income but you haven't received it, you got to pay tax on it. If you have incurred an expense but you haven't paid it, you get to deduct it. Now, IRS wants you to pay that expense within 2.5 months. But I use accrual accounting for my entities so I can pay my property taxes in January and deduct it in December. In Texas, your property taxes are due January 31, and I just don't want them to get my money any quicker than the absolute maximum. So that's a little strategy I use, and it works good on real estate because accrual accounting works good if you have liabilities or accounts payable or bills and no receivables. And there's little or no receivables in a real estate. But like when I had my accounting practice, I had very few payables and I had a lot of receivables. So I set my corporation up for my accounting practice as a cash basis. Whereas I set my real estate entities up for my, like my apartment buildings and my houses as an accrual basis. It just depends upon what you're going to do. You know, your type of business. It's a strategy that you can use. You use these strategies right, you can save yourself a lot of money. And I'm just going to talk to you about some other miscellaneous things that we've kind of alluded to. I mentioned AMT, or alternate minimum tax. Normally, you do your taxes, you take your income, you take your deductions, subtract your deductions, you have taxable income, and you figure out the amount of tax you owe. Well, AMT is set up, you take all that aside, and you do it all over again with different levels of deduction. And AMT kicks in about $185,000 income. So, and they have a minimum tax of 26%, which later goes to 28%. So you could have a large capital gain with a 20% tax, but the AMT will pop that in to maybe bump it up to 26. So if you have a large capital gain, have your CPA or accountant take a look at the numbers to see if you're going to get hit with that. A lot of people have no idea what AMT is, and the theory is they don't want people to be able to they want everybody to pay a minimum tax of some kind. In AMT, they won't allow you to deduct property taxes. Isn't that nuts? You can't deduct your property taxes. So here you're doing your taxes in one method, you go and do another method, and I can't deduct my property taxes. And there's more things in there other than that, and there's a whole list of items. So if you have a large gain or a large amount of income, consider this AMT. Now there's an additional tax called Obamacare. And I know everybody's going to kind of shake their heads on this. When they passed Obamacare, they now have, if you make more than $250,000 a year and you're a married couple, and it is passive income, which real estate income is considered, you have a 3.8% surcharge over and above that. And if you have like a salary and you make more than $250,000 a year, you have a 0.9% surcharge. So if you had a large gain, let's say $1 million gain, you would not just have a 20% capital gain, the AMT would move it up to 28%, then you add Obamacare, 3.8% more, that gets you to 31.8%. And that means you sell your property, a third of your gain goes to the government. Very few people realize this. Now, if you have a $10,000 gain, that won't hurt you, but if you got a big gain, yes, it will. Now, my question is, how do people get around that? Has anybody ever heard of a 1031 exchange? Yeah. Okay. 1031 is the chapter in the IRS code that allows you to trade. And you have to trade like kind. Now, like kind, it's kind of got a wide definition. Real estate for real estate. What is real estate for real estate? I have seen people trade a piece of land for a condominium. I've seen an apartment building for a lot. I've seen a mobile home park for a farm. All of that is considered real estate. So you can do a trade from one property to another. Now there are some rules. Now, I'm going to talk to you just about the very top of the outline of the rules. If you want a clean exchange, your new property needs to cost more than what your old property sold for. So if you sold the old property for $1 million, you need to buy something for $1,050,000. Also, there's a rule in there that if in the old property you sell it and you get a large amount of cash, you've got to put all that cash in the new deal. I don't like that. There are ways of getting around that. What you do is you go put a second lien on your property just before you sell it, pull that cash out, and then sell it cash for cash. Or do it right after you make the purchase of the new property. You put a small loan on there and then you put a bigger loan later. I had a 1031 exchange that I did a year ago where I had an apartment building that I'd owned a long time, and I sold it for $1,750,000. I'd had it so many years I had fully depreciated it. My basis was the land, 50 grand. I had a $1.7 million gain, and I didn't want to pay a third of that to Obama. So what did I do? I found a trade. And it was interesting. I had, even though I very rarely had partners, whereas my level of operation is a lot different than the previous guy, I did have one partner who needed some money, and he and I owned 85 houses together. So I traded my apartment building for his half of 85 houses. Now, he was willing to carry financing on part of it, and I didn't want him to get all the cash, so I went and put a second loan on my apartment building, and I put a big enough loan to where I only got $300,000 at closing, and that's what he wanted, and I had a clean exchange, and I paid no tax. Now, it took a little bit of effort and some legal work, and a lot of accounting work. That's my thing, accounting work. But a 1031 exchange really is a cool thing if you do it right. Inside it, and I did a simultaneous 1031 exchange. There are rules. There was a guy named Starker that sued the government and won, and allows you to do what they call a deferred exchange. That means you can sell your property and put the proceeds into escrow, so you can go find another property at a later date. The rules are you're supposed to identify it within 45 days. You can identify multiple properties and close within 6 months. And there's a lot of people doing it. Many years ago, when I was worked for the big accounting firm, I had an opportunity to work on Trammell Crow's tax return. And he had 6 or 7 levels of trades at that time. I can imagine what he had by the time he died. But he used these exclusively. Every time he'd sell a property, he'd find something to move it into, and he'd trade it up. He'd keep trading and trading and trading. And remember, real estate, like kind, is a wide open definition. A lot for an apartment building, an office building for a ranch. So you've got a lot of flexibility what you can do with it. In 1031 exchange, if you have a large gain and you want to take your money and put it into something else, that is almost a must in my opinion, because I don't want, in my example that I gave you, I would have had to pay over $500,000 in income tax. I can buy a lot of real estate with $500,000. So that is something that I think everybody needs to be aware of. Go see your CPA or accountant. If if you've got a deal, make sure that that the way you're doing it will work with them. Many of the title companies have escrow agents that'll take care of this, but be careful who you do business with, because what happened recently here locally is one of the title company lawyers absconded with all the money. And I knew an individual that had a 1031 exchange and put his money in her trust account, and she absconded with it. And he's going to have to pay tax on it, and he has no money. So be careful that you've got whoever is your exchange agent is reliable and bonded. I'm here to talk about a few partials of strategy. The worst thing you can do, and this is kind of preventing you having an IRS audit. A Schedule C, which is a proprietorship schedule, is the most audited thing on earth. You want to keep basically everything on your tax return off of Schedule C. If you are an unincorporated business, you would file a Schedule C on your taxes. And you're listing all your income and all your expenses on your personal return. And the IRS just loves to audit that. The second most audited thing is Schedule E. But there are 2 pages to Schedule E. The first page has like a list of your rental property or your oil royalties. The second page has a list of partnerships. That's that first page is the second most audited thing out there. So it's okay if you have 1 or 2 rental properties, but if you got 5 or 10 or a dozen or 2 dozen, definitely put them in some type of an entity that does not show up on page 1 of Schedule E. And I'm going to talk a little bit more about strategy in that area in a minute. But the worst things you can do is Schedule C and page 1 of Schedule E. I like to have flow-through entities. And we talked earlier about sub-S corporation, LLCs taxed as a partnership or a sub-S corporation, or any type of partnership. Those entities don't pay tax at the level the income flows to the owner. Well, when it gets to your tax return, you go to page 2 on Schedule E, guess what? You have the name of the entity, the tax ID number, and the amount of the profit or loss. Bingo, that's it. Virtually eliminates an audit. So instead of having an apartment building on a Schedule E, I set up an apartment building with a flow-through entity. If I have 2 or more owners, it's a partnership. If it's 1 owner, it's an LLC. It's a subchapter S corporation. And incidentally, a 1-owner LLC is not recognized if it flows, it becomes a proprietorship or goes on the wrong places on your return. So you do not want a 1-owner LLC. If you're the only owner, take a subchapter S election. If you and somebody else own it, do a partnership election. These are strategies for you. And I like to see tax returns where I have lots of partnership items. There is a form called a K1 which lists your summary of your partnership or subchapter S. Form K1. I like to have a lot of K1s on my return. And the IRS schedules only have room for 4 partnerships. So if you have more than that, you have to have a supplementary schedule. And I think that's even better. It just gets it off their standard form. I have a separate entity for every commercial property. You don't want to put too many properties in one entity, in my eyes. I generally keep 10 houses per entity, and every commercial property, whether it's apartment building, mobile home park, office building, and I even own some pieces of land, I have separate entities for those. There's 2 reasons. Number 1, I don't want too many properties in one for liability purposes. And I think I like the idea of a corporation or LLC because you have liability protection. And you never know, being a landlord, what these crazy tenants are going to do. And I can tell you some stories that you wouldn't believe, except I saw it happen. So I think having a corporation or LLC of some type of liability protection is good for you in more than one way. Taxes 1, liability legal-wise number 2. Plus, the beauty of it is you look at at a typical tax return that I like, you see a lot of partnerships with a name, the federal ID number, and an amount. That's it. Very little information on your return. It's perfectly legitimate. My philosophy is give the IRS the minimum amount of information that they ask for. Also, other things that we have not talked about. Installment basis. You are allowed to, if you sell a property and you take and you finance it, you can take that capital gain pro rata over the life of the loan. So if you sell a property for $100,000 and you get 20% down, you only pay 20% of the capital gain. Then the next year you get another 2%, you only pay 2% of the gain. The beauty of the installment base is it defers that gain over the life of the note. If you got a 30-year note, you can defer that over 30 years. It's a nice strategy. And I have been known to buy a property, spend a lot of money fixing it up, taking a big tax write-off on it, then selling it and carrying the financing, and defer all of that for many more years into the future. A 1031's another way of doing it, but installment, and I've always found you can get a lot higher price if you take installment basis, but you also got to be sure that you've got somebody that's going to pay you too. There are other things that you can do for taxes. I strongly recommend everybody file timely. There's nothing wrong with an extension, but I know people that wait and don't even file until after the extension date. File timely, any taxes you owe pay on time, and that is probably one of the best ways to not have a problem with the IRS. Depending upon your business, if you're like in the hard money business, we may have a different strategy with hard money people. They're going to have a lot of taxable income. There aren't going to be depreciation, not much write-off, just a lot of income. And in many cases, I will set that up as a C corporation. Not always, depends upon your personal situation. But generally speaking, I want flow-through entities. Also, one thing we've done with the hard money people that I've had, and I did a number of hard money people when I had my practice, is it's a beautiful thing for a pension plan. And there are pension plans out there, depending upon your age and how much your income, you can put as much as 100% of your salary away. And what I had the hard money people do is do one of those pension plans, and then they'd load, the pension plan would invest, would loan money out with hard money in a tax-free situation. Now, that doesn't work if you own rental property, but if you're in a hard money business, or you're in maybe you're a contractor and you make a lot of money as a contractor, or you know, the guy that that does our Coke machines, he's got 600 or 700 Coke machines around town, and he makes a lot of money. That might be the thing to do, be a C corporation. The negative about a C corporation is you pay tax, and then if you take a dividend, you got to pay tax again. Even though dividends have a lower tax rate than normal. And you just gotta weigh a lot of things back and forth. Also, if you're in a partnership, I can tell you, if you're the general partner or the person putting together the partnership, please get the tax returns done early enough so they can file on time. I have a friend of mine that was complaining he's not going to get his K-1s till May. He has to file an extension. And that's just, I think, poor common courtesy. That's just my opinion. Just try to get these things done as early as you can. Also, if you got multiple entities, which I do, I like to do them all but don't file them, and then look at the gross numbers, and maybe I could adjust something some way or come up with something different. Maybe I could capitalize instead of expense things. And I'm going to talk a little bit about capitalizing repairs versus expensing. It depends upon who you talk to whether you should expense or itemize. I can tell you, any repairs you do at $500 or less, the IRS won't bother you. I saw a CPA that depreciated a waste disposal under a sink over 40 years. The darn thing cost 45 bucks. To me, that was stupid. But I inherited that client after we had started after several years afterwards, and once you set up a method, you're stuck with it. Until the disposal went out, then I could write it off. And it took 13 years for the disposal to go out so I could write the rest of it off. But generally speaking, anything, no matter what it is, up to $500, IRS won't even bother you. Of course, the question is, what if I'm doing something that costs more than $500? The philosophy that I use, I am repairing the house to where it should be, or apartment to where it should be. If I am doing an add-on, like I'm adding a room, or I'm converting a garage, that should be capitalized and expensed over a period of time. But if I buy a house and it needs a paint job and it's got holes in the wall and some of the faucets are running, I have to replace the faucets, I have to replace the carpet, I'll expense most of that. So I'm just kind of sharing with you my philosophy in regard to expensing versus capitalization. And I have seen some CPAs capitalize everything, and then I've seen others that expense everything. I kind of look at, the way I do it is, what can I do with IRS? You know, that's my philosophy. And it is amazing sometimes what IRS comes up with. There's another set of rules called active versus passive. And this is crazy. If you have a salary and you've got 2 or 3 rentals and you have a loss on it, you're limited to the amount of loss you can take. If you make $150,000 a year, you can't take any of that loss against your salary. None. At $100,000, you can take it all, and between 100 and 150, it's pro rata. You can only take part of it. Of course, you can carry it forward infinitely until you use it at a later date. And you sell the property, then you could use all those unused losses. To me, that's terrible. The way around it is becoming what they call an active investor. And an active investor is considered, you have to be in the real estate business. Now, what is real estate business? It is amazing, the definition. You can be a real estate lawyer, a real estate accountant. You can be a realtor. You can be a title company person. You can be an appraiser. The definition of a real estate person is very broad. Now, if you're selling clothing, you can't do that. But if you are in one of those businesses, then you don't have to worry about the active passive rules, and you can take as much write-off against your other income. Another attribute of active versus passive is 50% of your time needs to be spent in real estate, and more than 750 hours. I had an individual that sold equipment, and it had nothing, this is equipment that didn't have anything to do with rental properties. And he started buying rental properties, and he got up to the point where he had 60 houses. Well, guess what? He gets audited, and IRS disallows his losses. Even though I had a log showing that he spent more than 50% of his time in real estate, and he later got fired because he was spending too much time doing real estate and not selling. Well, we beat it at appeals. But my point is, if you have something like that, be sure you keep a log, be sure you keep your records. Also, when you look at, I had another client that was a hard money guy. And guess what? He gets audited too. I'm just sharing a couple of things that have happened. And he would foreclose on property, and he couldn't sell them. So he would rent them out in some cases. In other cases, he would sell them and carry the note. Well, the IRS comes in and says, no, none of that counts. It's all one business. We want you to pay not just income tax, but Social Security tax. You can't take the installment basis. This is all considered your business. Well, we beat that one at appeals because we had, you know, we showed where he couldn't sell a house. He went ahead and rented it out. A few years later, he sold it, and we took a capital gain and took a capital gain break versus ordinary income. So be sure you have a good accountant that's not afraid of the IRS, and you have good records. Any questions? Yes?
What's the number one mistake you see rental property owners make with regards to paying too much, more than they should, to the IRS?
Oh my gosh.
You gotta pick one.
That's a tough one. I think the biggest problem they have is not having good records. And it is amazing. I had an audit, this is a number of years ago, and this guy had, I could look at his return and tell he was going to be audited. And we got audited. He had perfect records, everything documented, a copy of the invoice, a copy of the check. This guy even went to the IRS circular and made a copy that said he could deduct it. And this auditor just had his mouth wide open. He couldn't believe it. No adjustments. My point is, have good records.
So, on that, Scott, top 3 records to keep: mileage log, repair log. Like, if there's 3 things people need to change tomorrow.
Well, mileage is one thing. And on automobiles, you have an option of deducting X number of miles for you driving. But if IRS audits you, they want to see a log showing where you've been, what you've been doing, where you went, in a description. The same thing if you do any entertainment. You need to write down, have a receipt, and who you entertained and why. Now, we talked about active versus passive. If you are concerned about that, you need to have a log on your time in addition to your automobile. And this individual had time in detail where he worked, and even though at the first level it didn't work, it sure worked at appeals. Have good records, and logs are very important. Have receipts to back up what you have, and be able to get to them. How you file them is up to you. But it is amazing, if you've got good records, how successful you can be in an IRS audit. Yes?
So you were talking about liability and putting a certain number of properties in different LLCs. What about the series LLC?
All right, let me tell you about the series LLC. This came from my attorney, who's a real estate lawyer. And yes, you do have the protection. But this guy got sued, and he had 6 or 7 different series, and the judge didn't recognize the protection of it. It's confusing to somebody like a judge, and he said they gave him a judgment when they shouldn't have. So he is against it, because he said, have your entities not with the same name, have different names. That I like to have names that aren't even close to me. Like the name of my management company is Alden Short, and I get calls all the time from Mr. Short. And we tell him he's not there. You know, I don't want to name my company Scott Belsey Company.
My favorite was Mecca April.
Yeah, that's Freedom in April.
Because he was in the sack business, right?
Yeah. I also have another one called Mecca May, and I got a letter from somebody wanting to buy my house to Miss Mecca May. And it said ink. They didn't even read the word ink. My point is, I like to be very low key. This is my personal opinion. Also, the nice thing about some of these entities is when you set a corporation up in the state of Texas, the only thing you have to set up is one officer and a registered agent. And then you can change that, and they don't even know who owns it. It's great. Go ahead.
So the benefit to using
I don't like them at all, and there's laws in states like Michigan with land trust written all over it. There's nothing in Texas. And it depends upon how you decide to tax this land trust. Are you going to tax it as a proprietorship? You don't want that. You want to tax it like a flow-through entity. And I don't know how you can do that. Yes?
So Scott, about 2 months ago, you and I sat down, looked at my returns from last year. Last year I had really high W-2, and one of my LLCs, I have 6, 7 LLCs. One of them was set up where it wasn't a partnership, so it flowed through to my Schedule C, and you hated that.
Absolutely.
Can you talk a little like?
Oh yeah, you had a one-owner LLC. Remember me talking about a one-owner LLC? It's taxed as a proprietorship. IRS does not recognize an LLC. But an LLC, you can take an election for my LLC to be a partnership, a sub-S, or a C Corp. And what he should have done in that case is taken an election to be either a partnership or a sub-S Corp. You remember the first thing I said today? Stay away from Schedule C. And I can tell you, I can look at a return, and if there's enough action in the Schedule C, I can almost guarantee you an audit.
Yeah, thanks by the way.
Sorry. We're talking strategy. You stay away from certain things. And I just think if you it's like a little preventative maintenance on a piece of real estate. You got to do the same thing on your taxes and your bookkeeping. But it is amazing what you can do if you plan a little bit and how much taxes you can save. Any more questions?
So,
Go ahead.
we're going to let you guys be done. Like I said earlier, Scott manages all of my rental properties from cradle to grave now. So when I just buy one, sounds awful. I just kind of throw it over the fence, and he and his company have to figure that out. You have to be of a certain minded investor for him to do that. Like if you're really on your first one, it's probably not going to work out with someone like Scott. But it's not about Scott as much as it is someone like Scott. If you have a property manager, make sure they own rental property. If you have a tax advisor, make sure they own rental property. Make sure they own their own businesses. Because when they can give you a point of view, in his case from 100 years of experience,
Sorry, not quite that old yet.
5 or 6 years of experience and practical application of the trade that you either are in or want to be in, you get better advice from the get-go. And so appreciate all you guys sticking around. I'm going to wrap this up, and then Scott can stay here if you guys want to pepper him with a bunch of questions afterwards once he gets off the stage and maybe grabs a beer because the bar's about to close. So thank you for coming. We'll see you next week. God bless. Drive home safe.